So hello everybody, thanks so much for coming.
Oh, do you need your slides?
The panel.
I mean, I'll go.
And we're,
Fine, but
I can get them for you.
this panel is moderated and curated by Martha McCluskey. So Martha teaches at Buffalo Law School. She earned a JD from Yale Law School
okay, how do you do that?
and an SJD
I
with
had logged
distinction
into
from
my
Columbia
email,
Law School. Before entering academia, she was an attorney for the Maine Public Advocate Office. Her scholarship
laptop right
examines
here.
the relationship between
just pop
economics
it.
and equality in law, as well as critical legal analysis of gender and race. Martha is working on a book titled A Field Guide to Law, Economics and Justice. She's the co-editor of Feminism, Media, and the Law, Oxford Press 97, the Class Crits Project and Appeal, which brings together scholars in law, economics, and other disciplines to develop a critical legal analysis of economic inequality.
And let me
you,
just,
Martha.
thank you so much, and great to have you all here. And this panel itself is an outgrowth of the Appeal Group, the Association for the Promotion of Political Economy and Law. And so a lot of us have come together through many overlapping ways, but particularly through that group. And you can find our website at politicaleconomylaw.org. And we welcome you to sign up and be on our mailing list. So I'm just going to very quickly run down all our presenters here. First, Thomas Herndon, Loyola Marymount economist, and famous as a UMass grad student for finding a spreadsheet error in the austerity paper.
Actually, from some economists here at Harvard, I was a little scared some might show up. They might still hold a grudge. But.
And Pamela Foohey at Bankruptcy specialist and in many other things at Indiana. No.
In Maurer School of Law, the one in Bloomington.
But, okay, I always get them mixed up. Okay, and so a finance and law person, and Kristen Johnson, also finance and law faculty now at Tulane University Law School, and expert on securities regulation and many aspects of finance. And finally, Jennifer Taub at Vermont Law School, expert on finance, author of Other People's Houses. That's got the title right. Other People's Houses on the sort of the mortgage aspect of the financial crisis. A wonderful book. I highly recommend it. And also, Jennifer is an expert on white-collar crime and on the current federal administration's intersections with white-collar crime. And so you'll often hear her on CNN or in other public places commenting on that. So with that, I'm going to just leave it to the panelists, and we'll have 10 minutes each and hopefully time for discussion. So starting on that end.
Sorry, my slides weren't on that laptop, but here they are, so no problem.
All right. And that'll come up. So basically, I'm going to present a paper today called A Public Option as a Mode of Regulation for Household Financial Services in the U.S. It's a paper I wrote jointly with my co-author Mark Paul, who's an assistant professor at the New College in Florida. So the goal today is to discuss the mechanism through which a public option could serve as a mode of regulation for consumer financial protection. This falls under the postal banking literature, and a lot of the postal banking literature has focused on increasing universal access and reducing financial exclusion. We also think that's an excellent goal, and we detail it in the paper. But because I have 10 minutes, I'm going to focus on what I consider one of our main value added, in that how can we use public-private competition to regulate consumer financial protection? So first, the features of this public bank. One, it'd be a public bank that would, say, partner with the post office to provide deposit and transaction services, and then plain vanilla consumer credit. We envision the full range of consumer credit, from mortgages to auto loans and small dollar unsecured lending as well. And then in addition, we argue that it should manage an online financial services marketplace where public and private services would compete side by side. Really quickly, I'll get into the regulatory functions in a second. We argue that directly providing services to households uses public-private competition to regulate the distribution of risk, really to shield households from risk. And the other regulatory function is the marketplace, in that we're providing a service to intermediaries, but you can condition access to that service on meeting regulatory goals, like consumer financial protection. And then I'll also discuss how this was actually a large part of the New Deal approach to regulating housing finance. It was very much at the core of it, and for example, the 30-year fixed-rate mortgage, it very much helped create stable financial services for households during the mid-century before deregulation. So before we get into the regulatory features of the public option, it's very important to understand about how debt contracts distribute risk, how that's related to consumer financial protection and macroeconomic stability. So debt contracts are inherently distributional in that they specify the distribution of different forms of risk between borrowers and lenders. For example, your typical consumer debt contract has many forms of risk. Interest rate risk, right? That's the risk that the interest rate will change over the life of the loan. Credit risk, the risk of default. Liquidity risk, right? That's the risk that you'll need access to external finance during the life of the loan, or you'll have to refinance the loan. And then collateral risk, right? If it's secured lending, that's the risk that, say, your house will fall in value over the life of the loan. And finally, there's prepayment risk, right? What if someone refinances and pays early and the creditor doesn't make as much interest as they could? And so debt contracts very much distribute this between borrowers and lenders. So if we consider the 30-year fixed-rate mortgage, what's been called the American mortgage, it's very much unique in a lot of ways in international and historical comparison, because it provides a high level of consumer protection by shielding borrowers from risk, right? The fixed rate shields you from interest rate risk. The long-term, fully amortizing structure prevents you from needing access to external finance during the life of the loan, right? Prior to the Great Depression and the New Deal, they had what was known as bullet mortgages, right? These were mortgages that were not fully amortizing. So you typically had between 3 to 5 years to make several payments, but at the end of those 5-year period, you would still owe something like half the value of the loan. And so you would have to take out another mortgage in order to remain solvent. Though, of course, that's a very risky, financially fragile structure, and the large-scale defaults in that risky structure played a large role in the Great Depression, right? During the peak of the Depression, half the mortgages in the country were in default. I'll get more into that in a second. But the long story short is the mortgages created during the Great Depression shielded those households from risk, right? Depository institutions would have to hold that interest rate risk. That there was some questions around that during the 70s, but there's no liquidity risk. There was still collateral risk on households. Also, we had the universal ability to prepay, so that shielded households from that risk too. Now, connecting this to consumer financial protection. So let's first, here's predatory lending, the definition from the FDIC. If they define it in basically 3 ways, right? One is inducing a borrower to refinance a loan repeatedly in order to charge high points and fees each time the loan is refinanced. That's very much concentrating liquidity risk on borrowers. And that's the main one I'm going to focus on right now, but there's 2 other things. One is just fraud as well. That's some of my research is on that. And the other one is making unaffordable loans based on the assets of the borrower. But let's look at a concrete example here with payday lending to see how payday lending concentrates liquidity risk on borrowers and falls under the first category of the definition. So, predatory lending, it concentrates risks on households and really the ones that are least able to bear it, right? So the structure of a payday loan is that you get a large loan and you have to pay it off in a single payment, right? But borrowers who need this, they can't make that payment and still meet all their bills for the next month, so they have to take out a new loan at the end of that. And that's why 80% of the payday loan volume is repeat loans to the same borrower over and over and over. And that's how they get the high fees on refinancing. And it's very financially fragile, because what happens if the borrower can't get a new payday loan at the end of the loan, right? Then they can't meet any of their obligations and they go bankrupt. And the interesting thing too is that if we look at who are vulnerable to these, right, it's the financially excluded. It's those who don't have access to stable, affordable financial services that shield them from risk. We see this all throughout the housing market as well in the history of housing, right? So in the mid-century, 3 minutes, I'll be quicker. In the mid-century, I'll just get. So very much, it's the credit-constrained borrowers who have risk concentrated on them, but they're the least able to bear it. By definition, they can't self-insure against these risks. And providing services so how could we regulate this, right? How could we stop this problem, the use of predatory services or different mortgage innovations that redistribute risk back to borrowers compared to the 30-year fixed rate mortgage? Well, one is just directly providing services to households. You give them a fallback position so they don't have to take out loans with a 400% interest rate on it, right? Another thing is, so that kind of competition, it puts a quality floor in the market, and you give people a fallback option, and it allows you to regulate from below, right? If we think about the CFPB, right, they can forbid the provision of services, but they can't mandate the provision of services. Also, due to the American federalist structure, there's a lot of different banking regulators, and regulatory arbitrage between them is a huge thing. However, with competition from below, it doesn't matter who charters your bank. If you're providing these predatory services, they're just not going to be competitive with the safe, affordable public services. In addition, we could provide services to intermediaries like the online financial services marketplace, but only allow services from the private sector that met high consumer protection standards allowed on there. And then that would both directly regulate the services in the online marketplace and then indirectly regulate the services outside of that as well. And really quick, to finish it up, because I'm low on time, I would say that this is essentially the most successful strategy that we've seen, I believe, in housing finance in the 20th century, right? It was the core goal of the New Deal. So, for example, the 30-year fixed rate mortgage I've talked about was essentially pioneered by the government, right? During the Great Depression, half the loans in the country are in default. The Hulk buys them and refinances them into this new stable structure. Moreover, and so that's how the government can pioneer and set the terms of the market by providing services to households. Moreover, this was actually more of the strategy. It was providing services to financial intermediaries, but conditioning access to those services on loans meeting consumer protection goals. The easiest one is to think about is FHA insurance. The FHA insured credit risk on loans to banks, so it provided them a service, took credit risk off their books. However, the loans had to conform to these new stable mortgages, right? And so, for example, there was a 5% interest rate cap under the FHA loans at the beginning, and so that acted as a usury law, right? And so that's a way. It's both a carrot and a stick. It's the power of the public option, and this was a key component of the New Deal that underpinned stable household finances. We propose to do this through a new public bank run through in coordination with the post office and online financial services marketplace, and this will help re-regulate everything from unstable mortgage finance to predatory lending, and essentially set the terms of the market to shield households from risk that's concentrated on them through predatory products. Right, cool. Here you go.
Sticking to the time limit.
Yep.
Perfect. Now we're gonna plug me in. Although I don't know how to do this.
Oh, sorry. It's
It's on this side.
Let me.
You took it apart.
I'm sorry. Let me plug it back in. Here you
So,
go.
okay. So first, thank you, Martha, for organizing this and also for letting me into appeal, which I totally love. I found my home. If I could open this. Let's see.
go to edit at the very top menu, the gray menu, and then view. I meant
go to
view.
view.
Sorry, view.
Here, I'll take care of it. You can just talk.
Okay,
Don't worry.
so my paper is about bankruptcy. It's based on bankruptcy data from the people who file bankruptcy, but it's actually not necessarily about bankruptcy. It's more about the lack of money that some people have in light of our fraying social safety net. So as I assume everyone in this room knows, over the past couple of decades, the social safety net has shrunk considerably. And it's particularly shrunk for older Americans, who are people we define as people 65 or older. And so Social Security benefits and eligibility has shifted. Medicare and Medicaid benefits have decreased. Defined benefit pension programs have been replaced by defined contribution plans that people must manage themselves. All of this shifts risk onto the lives of all Americans, but particularly older Americans, who then have to shoulder that risk by taking out credit, which debt loads over the past decades have confirmed. More older Americans are taking out credit, and they're taking out even more credit. Credit inevitably leads people to file bankruptcy, some of them to file bankruptcy. And that is where our paper begins. We report on older Americans' bankruptcy filings over the past several decades. And we rely on data from what's called the Consumer Bankruptcy Project, which is a long-term project that was started decades ago, in part by then Professor Elizabeth Warren, that studies the people who file bankruptcy. Right now, my co-investigators on the project and also the co-authors on the paper are Bob Lawless, who is at Illinois, now Congresswoman-elect Katie Porter, who is no longer on the project as of today, who is also on leave at Irvine, and Deb Thorne, who is a sociologist at the University of Idaho. So since the early 1990s, scholars on this project have asked people for their ages, which is not data that the Administrative Office of U.S. Courts has ever reported and does not report. So the data in this paper over time was developed by asking people who filed bankruptcy, what's your age? And of note, before I get to the results, between the 1990s and now, so over the last 25 years, we find an almost threefold increase in the rate within the general population at which older Americans are filing bankruptcy. We find an almost five-fold increase in the percentage of older Americans in the bankruptcy system itself. And the difference in the numbers has to do with some of the rate in bankruptcy filers within the population of bankrupt people is taken up by the fact that the American population generally has aged over the last 25 years. For one example, is the median older American who ends up in bankruptcy enters the system with a negative wealth of about $17,000. So they're $17,000 in the hole when they file. Their non-bankrupt counterparts have a positive net wealth of about $250,000, and that is what people survive their retirement years on. And I mentioned the last statistic because, again, even though this is a paper about bankruptcy, it's not actually about bankruptcy. It's about how America treats and protects its senior citizens, and how we have taken money away from them effectively. And we refer to the Consumer Bankruptcy Project as an early warning system of bigger issues within households' finances and society, hence the caution sign on this slide, and this is particularly true about this paper. So before I get to the results, really quickly on the methodology, the current Consumer Bankruptcy Project is an ongoing data collection effort. Every 3 months, we randomly pull 200 consumer bankruptcy cases, both Chapter 7 and Chapter 13, and then we send a questionnaire to debtors, which is where we get the age data and other data from. The paper relies on now 4 years of rolling data, so 3,200 household filings from 2013 to 2016. We have 910 questionnaires that were returned, 895 of which have valid age data. We compare this data to data from the 2007 Consumer Bankruptcy Project, which was a national random sample, except that one was a snapshot in time in which about 2,500 cases were polled over a 3-month filing period, and effectively the same questionnaire was sent to people. We also compare it to the 1991 and 2001 iterations of this project. Because of limitations at that time in that there was not really the internet, these iterations relied on samples from bankruptcy courts in 5 states or judicial districts in places that were both urban and rural and thought to be nationally represented. In 1991, in fact, they took a photocopier with them on the plane and then hauled it up the steps to get the data. And in 2001, now Congresswoman-elect Katie Porter, I believe, walked around with rolls of quarters in her pocket to photocopy stuff. Okay. So to the results, quickly. In the paper, we report about older Americans' bankruptcy filings in 2 ways. First, this graph shows the filing rate of age cohort per 1,000 persons in the U.S. population over time. Right? So starting in 1991, which is the lightest bars, through now, which are the darker bars, you can see the darker bars are getting higher and longer as you move across the age cohorts. And you can see over time there's been a sizable increase in the age of filers. By percentage, in the age range between 65 and 74, the increase is 204%. For 75 plus, it's 345%, which gets you to that almost 3-fold increase. And again, the increase in the age of the general US population only explains a small part of the increase in older Americans within the bankruptcy system, and it is these figures that show this because it's by age cohort in the general population. Okay. The other way that we report the aging of bankruptcy is this graph, which shows the percentage of older Americans within the bankrupt population. So the percentage of people 65 or 75 over within the filing population. It's increased massively in the last 25 years. This graph works in the exact same way. For 65 and over, the increase is 479%. The graphs show the increase, but then the question becomes why? Our data isn't causal, and we don't ask people, why are you filing bankruptcy, in a way that we can make a causal connection, but we do ask them what led you to need to file for bankruptcy. We give them a list of common reasons, and those answers can shine a light on the problems that older Americans face. So I have one table or one slide for this. This slide lists the reason that were most often cited by older Americans for why they ended up in bankruptcy. So 69% of them say decline in income. This includes job loss or from retirement drying up. This is about wages, retirement, Social Security, all wrapped together. Right? Older Americans also cite medical expenses, 62%. The comments they write to us suggest this relates particularly to inadequacy in Medicare and also Social Security to meet their costs. They also cite missing work for medical reasons, and you can imagine what happens when an older American misses work in terms of keeping their job and how that can spiral out of control. They also cite pressure from debt collectors at a rate of 72%, which is not unique to them, and it's actually a subject of a separate paper that's coming out in Notre Dame Law Review soon called Life in the Sweatbox, about how debt collection and debt collectors are pushing people into the bankruptcy system and how long people struggle in the sweatbox before they file. Right, so the final sort of data slide, the effects of all of older American struggles seems to be evident in the financial characteristics when they file bankruptcy. So what we did on the slide is pull out the key financials for households broken down by bankrupt under 65, bankrupt 65 and over, and then non-bankrupt 65 and older, which I think is the more interesting comparison to older Americans in bankruptcy and out of bankruptcy. The financial characteristics between those two are simply striking. I'll just highlight that difference in wealth I started with in the introduction, right? These people have nothing to live on after they file bankruptcy. which leads perfectly to my quick conclusions for the last minute or so, right? So we think of the Consumer Bankruptcy Project as this early warning system. The aging trends that we're reporting on now were noted in 2007 in an article by my co-author Deb Thorne, Teresa Sullivan, and then Professor Elizabeth Warren, in which they, quote, sounded the alarm. This paper is meant to amplify that alarm, right? It's not only older Americans who file bankruptcy who have debt issues. So between 1992 and 2016, which is the time I'm talking about in the paper, the percentage of non-bankrupt senior households with debt increased from 42 to 60%. The average debt of those households increased from $6,000 to $31,300 in comparable dollars. So you don't even have to inflate them. We did it for you, right? So people are turning to bankruptcy because it's the last remaining part of the social safety net that they can turn to. But bankruptcy is not a retirement plan, right? The paper is not about bankruptcy. Having people file bankruptcy sooner or more older Americans file is not a reasonable solution. And this paper and the data is really about money and how we take care of our older citizens and the magnitude of the coming storm of the broke elderly and what we need to do for them now. So I'll end there.
So this is, yeah, great. I don't have slides. I typically do. I won't have slides today, though. I am, however, hopeful that I can offer sort of the next iteration, right? This panel has been perfectly organized thus far because to a large extent, I want to ask Thomas lots of questions about the history of consumer protection and mortgages. And I have tons of questions for Pamela about the idea that we can imagine credit in a new light. And we can also imagine in a population that's aging lots of concerns about how they'll navigate and manage credit. I would like to talk a little bit about the future of finance. So to add sort of the third leg in the stool so far, I'd like to discuss a series of projects I'm working on that relate to the advent of data science and artificial intelligence in financial markets. The introduction of data science and artificial intelligence in financial markets represents a seismic shift, I would argue, in the development and execution of conventional equity and debt trading securities, payment systems, think Zelle, Venmo, PayPal, and credit scoring and lending practices. Today, data aggregation, mining technology, and automated decision-making promises to redefine financial market intermediation. In a previous paper, I spent lots of time examining the introduction of algorithms and high-frequency trading in equity securities markets. As Martha noted earlier, it is my heart and my home. These trading strategies alter the pace of financial market transactions, initiating an arms race as market participants compete to decrease the time that elapses between the moment when a trader signals, right? I could do those baseball signals, they would suck because I don't know anything about baseball. But you recall them well from Trading Places. Now we're going back to who's aging in the population. If you saw the Eddie Murphy movie Trading Places, you saw that sort of those baseball signs. And you recall sort of an equity market whereby there was a securities exchange and a securities exchange floor where a floor specialist would receive trades from broker dealers in the market and encourage them or facilitate the execution of those trades. Automated trading challenges long-established core principles in financial markets regulation, such as disclosure, transparency, and fairness. In the late 1960s, electronic communication networks replaced antiquated securities and commodities trading practices with automated trade execution technology. During the last few years, developers have accelerated the pace of change in securities and commodities trading markets. I'm here to talk to you today about a similar trend emerging in credit scoring and credit lending markets. I'll use my remaining time to discuss the types of artificial intelligence that are, interestingly enough, transforming credit scoring and credit lending, and I'll describe a few very specific models. Before I launch into the models though, I'd like to talk just a bit about what I mean by artificial intelligence. So very specifically, algorithms have long been used in credit scoring processes. If you have a FICO score or are familiar with Experian, Equifax, TransUnion, right? Anyone seeking to use consumer credit or credit in a number of contexts is familiar with these platforms. I would describe them as a form of financial market intermediation. They provide a service that signals the creditworthiness of the consumer. They've used algorithms to score our society, borrowing from Frank Pasquale's Scored Society with Danielle Citron, to score our society for a number of decades. Today, algorithms are changing. They're changing dramatically, and they're changing the process of credit scoring and credit lending. Machine algorithms today automatically detect patterns in data. Upon discovering patterns, machine learning applies these patterns to predict future outcomes based on the supplied data, of course. These methods engage in complex decision-making and apply logic to resolve uncertainty. Instead of sort of relying, as we have historically, on data to tell us what you've done in the past, algorithms today will predict what you are likely to do in the future in a way that transforms credit markets. Now, credit is increasingly essential in obtaining necessities. Increasing numbers of vendors require credit cards to complete any number of consumer transactions, right? Processing a credit card or having access to a credit card is often required to rent a car, to purchase an airline ticket, to shop online. Without sufficient or often good credit history, it may be difficult to qualify for certain educational loans, credit cards, or a mortgage. As of March 2018, consumers navigated astoundingly $1 trillion in credit card debt, and over $1.5 trillion in student debt, and almost $9 trillion in mortgage debt. During the first 3 months of 2018, household debt increased by $63 billion. The numbers are staggering. And consumer lending has long been a critical challenge, as Thomas described and as Pamela described as well, for consumers to navigate. I'd like to use the remaining time to talk about the emerging or future platforms for credit lending and credit scoring. And I'll talk about 3 very specific, or maybe 2 depending on my time. I'm up to 5 minutes now. I'm watching it carefully, Martha. I'll maybe only talk about 2 so I can focus a little bit more on solutions in the end. But I have organized for the purposes of this paper sort of 3 prime examples of how we're witnessing a transformation in consumer scoring and credit lending in light of the advent of any number of technologies. So I'm going to start with one domestic-based firm first, Atlanta-based GreenSky LLC. This firm offers consumer credit online and has already extended credit to almost 2 million households and individuals. It is a quintessential fintech firm. Note, non-banking financial institution, relying on technology to offer something historically offered only by financial institutions. Want to talk about some safety net concerns? Okay, we'll come back to those endogenous and exogenous consumer-oriented risk management concerns, as well as systemic risk concerns I'd proffer. And I'm hopeful to talk to Pat McCoy later about sort of some of these very specific issues. GreenSky is a quintessential example of a fintech firm. It has a proprietary technology that facilitates something called point-of-sale financing. Essentially, that just means a retailer will offer a portal on their website that enables GreenSky, in a moment, literally less than 60 seconds, to ascertain whether or not a consumer seeking to purchase something online is a good credit risk, or in other words, are they credit worthy, right? GreenSky expressly disavows any suggestion that it is a financial intermediary, but in fact, it is intermediating a kind of finance, right? So GreenSky partners with banks. I'm sure you're wondering now exactly what their platform offers. Partners with banks upon the conclusion by GreenSky that an individual consumer is credit worthy. The banking institution standing behind GreenSky will actually facilitate a transaction on behalf of or extend credit to the individual consumer. GreenSky boasts now 12,000 retailers and service providers, including large corporations, as well as any number of small, medium-sized enterprises or individual family-owned businesses. GreenSky's platform executes the entire transaction cycle of credit arrangement. That's underwriting, documentation or distribution of documentation, funding, and settlement. The entire process of underwriting a loan, GreenSky can execute from your smartphone or mobile device in less than 60 seconds. Right. Okay, I'll offer just a second example and then I'll move on to talk about some correctives or interventions that are critical in this market in a second. So the second I'll offer is Klarna. Klarna is actually not a US-based, but an international online platform. Klarna does sort of a number of things very similar to GreenSky. However, Klarna, even more interestingly, and here's where we'll sort of dig deep or dive a little bit into what happens in the process of machine learning as an algorithmic process versus your conventional use of algorithms or your average if-then statement. In the context of conventional algorithms or those that were used by FICO, Experian, TransUnion, Equifax historically, there might be an if-then conclusion. If you've missed a certain number of payments, if your credit history is particularly weak or particularly limited, no access to credit, right? A simple if-then statement based on historical facts about your payment history. Klarna is one of the number of emerging platforms that is using alternative data to ascertain whether or not individuals ought to qualify for credit. Among the types of alternative data we are now witnessing, and Klarna expressly uses, your email address or IP address and your zip code. Thomas is already thoughtful about the idea that this looks like redlining in the mortgage industry that we saw, right, decades ago. However, no, this isn't that, according to Klarna. According to Klarna, we could rely on this data to mitigate the likelihood of fraud, because if you're using your own mobile device or if you're sitting in your own home executing transactions from your IP address, that too should be a point of verification as to who you are. And in fact, according to the online retailers using these platforms, it's a better point of departure for confirming that no fraudulent activity is taking place, right? So we can imagine, and we'll talk a little bit more about other types of alternative data that these platforms may be using. I'd like to shift the conversation for 2 seconds to the greatest concerns and some of the interventions. So easily you can imagine that a number of concerns emerge from the use of this alternative data and also from this sort of reliance on machine learning and deep learning algorithms. And I'll just borrow from the literature wholesale at this point to suggest that a number of authors have carefully detailed the likelihood that these processes will lead to a disproportionate or a disparate effect in the context of particularly vulnerable or marginalized borrowers. Those who have historically been excluded or at least faced the least favorable borrowing terms in credit markets are likely, again, in light of sort of this alliance between financial intermediaries and technology platforms, they are likely to also remain in dire straits. Thanks, Martha, I hear your tone. So one of the things that I'm proposing, or that's widely been proposed, is reliance upon auditing firms to engage in a process of auditing the algorithms that are used by these technology-based platforms. I don't find that intervention in and of itself to be sufficient, in fact. I think, in part, one of the major governance challenges for entities using these types of algorithms, one of the major governance risk management concerns, in my humble opinion, is that there's a lack of diversity among the programmers who are developing the platforms, as well as those who are making business decisions related to the credit entities themselves, or the platforms themselves. So in a paper that I'm publishing with George Washington Law Review, I explored the significance of increasing the representation of women and diverse persons in the programming of these algorithms, as well as in the governance process, sort of the highest ranks of the firms that are launching these applications. So I'll pause there and concede my time, or I'll save remaining time for Q&A or questions for Q&A.
Thanks.
Thanks.
Pamela, can you pass me the laptop?
Jennifer Tao.
This is witness the ceremonial passing of the laptop. Now.
I love it. This couldn't fit better together. This is just.
I know. I want to. After hearing the. I know. I want to rewrite this. Where does this? Thank you. Thank you. Full screen mode.
Your eyes are great.
So much for these bifocals. So, thank you so much, Martha, for organizing this panel, and I would also thank Chris, or somewhere, for organizing this whole conference. After hearing my fellow panelists speak, I now almost want to just jump into questions and comments for them, but I promised to talk, and I think that I also have a meta-analysis of what I'm about to say fits what they're going to say, but I'm going to skip that and just kind of tell you what I want to say, and then maybe the questions and the discussions, we'll get to that. So the title of my talk is Saving the Canaries, Protecting Consumer Borrowers to Prevent Systemic Risk. And like Pamela, I'm talking about why we need an early warning system And I'm also here to address sort of the most fundamental principles that we're discussing at this conference. So we've already established, I think, the argument that credit is money. And often we talk about access to credit, but it's really important not to think about credit access as the only democratic principle, but also this idea that it's not just having access to credit, this idea that if we could only lend to people who have lower credit scores, and they'll have access to things like higher education, they'll be able to pay medical bills, they will be able to have access to housing. In fact, that's not, I believe, the solution, because ultimately there are some things that used to actually be free. And if they were free again, I'm thinking about higher education. In my lifetime, the state of California had free higher education, and we can go on and on and on. In other countries, we have essentially free medical care. It's the fact that things cost too much that's the problem. And continuing to rely on, in the society that we do, rely on credit extension to solve those particular distributional problems is a disaster. Okay, so, but here's the deal. My saying that is like Polonius and Hamlet saying, never a borrower or a lender be, right? We are borrowers, we are lenders. So what is my suggestion for what we should do inside of the existing system? And this is where this key point, it's important, which is the question of who can deleverage in our society without self-destruction is a democratic concern. And by that, I'm talking about specifically questions around bankruptcy that Pamela has raised, which is we've seen how when a business is failing, it goes into a Chapter 11 bankruptcy. But that's not how the language we use. We say this company filed for protection under Chapter 11 of the Bankruptcy Code, right? It can get a fresh start. Now, sometimes it's going to liquidate later, but the people who ran that business, who were in charge, who oversaw its demise, end up just fine, and the company's assets, and sometimes the company itself survives. When a consumer enters bankruptcy, whether it is a 7 liquidation or a 13 restructuring, we don't talk about it that way, and they don't get to deleverage in the same way. And so I think that's the sort of, after everything I say after this, I think that's the key point. We need to think about in this society deleveraging without self-destruction. Okay, so what I'm working on now is this paper on trying to create or establish some sort of index or several indexes as a metric for predicting systemic risk. And so I've got 3 claims that back this up. The first claim is that consumer borrowers are like canaries in a gold mine. And yes, I know it's a coal mine that canaries were sent into, but I'm talking about a gold mine like the financial system. And if we think about how canaries were actually used, it was way before the high tech that Kristen is talking about. You would have the coal miner go into the mine with a canary in a cage like I showed you on the first screen. This is actually a photo. I just flipped it around because I like the way it faced better. This is actually a photo of a coal miner taking the canary in there. And the idea is that, as you know, the canary is going to detect lack of oxygen or excessive carbon, I guess it would be dioxide. And then if the canary looks ill, looks weak, dies, we know, let's get the humans out of there. And what we have seen historically is that consumer borrowers are the first to show the visible signs of suffering from these emerging, predatory and toxic products that banks and other financial institutions and non-financial firms offer. And the problem is, let's assume for a moment no one cares about the borrowers. They're just like the canaries, and we don't care about them. The idea is that they're going to help predict perhaps systemic risk, because if something is very popular, it's going to grow faster than we might expect. And this isn't just a theory. This is also, there are correlations that economists have shown between this overburdened household balance sheets and financial instability and systemic risk. Okay, so the second claim, and I'll get to those soon. Second claim is that we need a further cross-disciplinary studies of systemic risk and consumer financial predation. And I'm glad that the group Appeal I work with, as well as this conference and this panel, we do have one economist on here. But often lawyers, don't speak with legal scholars don't speak with financial economists, and it's rare to have legal scholars do the kind of empirical work that Pamela is doing. It's growing, but it's not yet the norm. So we need to work together and have these conversations. And then the third claim is that I want to develop what I'm calling a macro home economics. We think of home economics. I once treasured this book because I don't know why. I'm obsessed with money. And because I had this book about when I was a child. I never, when you run a household, here's how you can use your money more efficiently. And I remember these things that they tell you as if it's a micro problem, right? Mm-hmm. And this is the same thing as don't have a latte because then you won't be able to pay for college. And we've seen, like Helene Olin's book, Pound Foolish, tries to debunk that. The problem isn't the Starbucks coffee you get once a week. The problem is that if you have a health problem, you're going to go bankrupt, right? And so this idea that we need to think about home economics as a macro issue. And so the idea of this canary index, it would be trying to measure household balance sheet stress, sort of like the stress test we put banks through. And it also, as a result of this, if we understand this better, maybe we can act in a more counter-cyclical way and put sort of policies in place that get triggered, like that take the air out of the bubble from the ground up. So things like we need to fix consumer bankruptcy to allow consumers to reduce principal, right? This is one of the big missions of the book I wrote, Other People's Houses. We need student loan debt, which is now $5 trillion. Mm-hmm. We need, I think, 5-year plans to discharge student loans, whether it's through the bankruptcy court or a more beefed up IBRP, income-based payment programs. I actually think that higher education, there should be a public option for that but we don't, until we get there, we've got to deal with the people already. There's already, no matter what we do in the future, there's $1+ trillion of debt out there. Okay, so how much time do I have left? So I want to go through, since I'm talking about preventing systemic risk and I'm talking about promoting financial stability and using consumers as an early warning sign, I think I need to talk a little about definitions. So what's nice about these words that get used all the time is there are no definitions. So systemic risk is used 34 times in the Dodd-Frank Act, various places. There's this important systemic risk determination that needs to be made. There's collection of systemic risk data from private funds. These are like hedge funds. There's systemic risk study of insurance companies. There's a whole thing about swaps and systemic risk, but nowhere a definition of what systemic risk is. Isn't that lovely? So what does it mean? I'm not going to read through this to you all, but Steve Schwartz has a definition. Andrew Lowe, you might know these names, have definitions. The Office of Financial Research has some words in, and just to quote, Flood and Lowe, et cetera's paper, because systemic risk is not yet fully understood, measurement is obviously challenging with many competing and sometimes contradictory definitions of threats to financial stability. So he's kind of blending these words together. They're different categories. Obviously, shouldn't surprise you, macroeconomics, market, credit, solvency and leverage, funding and liquidity, contagion. These are the things that can be early warning signs, but where do consumer debt fit into that? Fundamentally, I like Steve Schwartz's definition of systemic risk, which is, it's kind of like, it's what happens, it's sort of a fragile system, and if there's a triggering event like an economic shock, that there's a domino effect, and these can lead to a chain of failures. Okay, so that's systemic risk. Again, that's systemic risk, not a perfect definition, but you kind of get the idea that it's like a fault line that something can, problems can be follow from that, knock-on problems. So this page here comes from the paper from Andrew Lowe and others from 2012, this working paper. And they have this particular table. And in this table, you can see I've put these big arrows to see they're listing all these factors since no one's defined systemic risk, and they kind of weave into forward-looking measures, consumer credit. Okay, so financial stability, even better. This appears 94 times in the Dodd-Frank Act, including the preamble. In fact, Title I is called the Financial Stability Act of 2010. Even the FSOC, the Financial Stability Oversight Council, was created, not defined. Okay, so what does it mean? So many really good definitions. Just to say, people talk about financial stability means having a financial system, a system of banks and non-banks that can provide credit intermediation. We often hear that. We talk about I like this definition a bit better. The Federal Reserve updated this May. They think that financial stability is a financial system that meets the needs of average families.
that's really
That's interesting, right? So, did I get this? Okay. So, let's talk about the early warning signs. Earlier I said there's a correlation between consumer predation and consumers, acting like canaries, getting sick, financially dying, and the crisis. We have Pat McCoy, who's here today, and Kathleen Engel wrote an amazing book called Subprime Virus. It was published in 2010, but they were doing work in 1999 and 2001, and they began to hear these words, predatory lending, in Cleveland. And when they tried to bring up these issues, they were greeted with derision. Similarly, Rui Maurer, who's a lawyer on the front lines in 2004, saw consumers struggling, and she met with a group of members, a group within the Fed. Some of the governors are on this attended the consumer council meeting she was part of, and they just basically told her this is just anecdotal data, right? And they said, our economic models don't see this. And they kept going back and saying it's anecdotal. And let me tell you, the economic models are still not accounting for this yet. This is what I want to build. Okay, sorry, time's up, but I'm still going to, a couple more things. So we heard about Ding Baker earlier. So I just have a lot of different, just trust me, there's many sources. I should give a lot of credit to Amir Sufi and Atif Meen, whose work, the book House of Debt, and their continuing work on the links between household balance sheet stress and the crisis in the past and going forward. Again, lots of sites here. Okay, so let me just go, I guess I'll jump to the end. I have some more on Minsky here. What would the Canary Index entail? The big question is it one meta index like, Jane Austen's key to all mythologies? No, I think you need to have a series of different indicators. So what Pam is working on is one piece of it. But what I want to make sure we can look at is on a micro level. I don't think you can just look at averages, right? We have definitely 2 or 3 or 4 Americas. So I'm thinking about assets and liabilities, relative to trends and relative to the age of the borrower, historic costs, cash flow issues, their income, the identities of the lenders, default and bankruptcy histories, all these different pieces. This should be forward-looking and look at the implications for borrowers and lenders. So this index would say, somehow it was it's the idea of having the Case-Shiller index, but looking at more things than just housing and trying to predict how stressed borrowers are, how maxed out they are. So looking today, there's $13 trillion in household debt as of August 2018. This is just from the Q3 2018. This is from the Fed, and you can see this is the non-housing debt and housing debt, and it's growing. And also, this is also a lot of fun from the Fed flow of funds. They don't call it the flow of funds anymore, but this is, you're looking at household net worth and the growth of domestic non-financial debt. And you sort of see the percentage here, and if I'm just kind of circling it, it's creeping up. So this is the time we want to think about this. Now, on the other hand, there are folks, just to say the other side, that say this isn't a big deal, household debt relative to GDP. This is the number we should be looking at. So there's a lot to consider here. So in conclusion, I welcome people's thoughts. I'm going to be working with I'm going to develop this into conceptual paper and then try to look at what data we have available and try to build some models with an economist friend of ours. But ultimately, I don't think looking at consumer stress is fighting the last war. I think every single crisis, whether it originates in housing or originates in the banking system, originates anywhere, always affects consumers, always affects housing in the end, always affects people's jobs. And again, my main point here is who can deleverage without destruction is a social justice issue. And what I think we're going to see with these indices is if we see early warning sign, what's the next thing, we need to have policies in place on the fiscal side and really rethink issues of what needs to be paid for in money and what the state should actually provide to people, because I think that will end up being the only solution we have to these cycles. Thank you.
Okay, I'm going to just offer a few comments before we open it up to questions. And, well, really, these are kind of questions that made me think about how these papers intersect. And one is that the theme of this panel is democratizing money's power and protection. And we know how much protection and power as the public, the state, gives to the private creditors at the top level. And so this looks down the line, the hierarchy, and asks, I think, what are we doing to really protect and give people power, ordinary people power, through this hierarchy of trickle-down credit? And one question I have in that is, in designing a system to democratize that power and protection, how far are we going, or how far should we go in that design to move from the model that this conference is challenging us to do, the model of money based on private, decentralized, so-called market transactions, to a truly democratic purpose and process? And because I come to money through insurance regulation and doing insurance law. And so one of the questions there is looking at how much insurance regulation and regulating finance uses as the model with the private market, so-called, and focusing on as a commercial transaction of financing. And so to what extent should we be, or are the different presentations here pointing towards how we could move away from trying to perfect an idea of finance as a decentralized private commercial transaction to something that really changes the nature of getting access and power from finance? So that's one question. Yeah.
So I mean, I'm going to challenge the premise. I don't think there is any private money. Like,
yeah.
I don't think any of the financial intermediation, even the especially the shadow banks and non-banks, can be standalone from the sovereign. It just doesn't happen. We can look at the 2008 crisis and again see who got bailed out and who got the government backstops. I mean, when they stepped in to save the money market, mutual funds. That tells you that was the closest thing we can think of, I think, to private money. But all these so-called private transactions, first of all, as contracts, require the state to back them up. But even so, there is the full faith and credit of the U.S. government to step in and rescue them. So I think what I want people to sort of see and admit is that that backstop is what creates the moral hazard on the lending side. And it seems incredibly unfair that this is the game we play again and again and again, and the victims of this, who then get blamed for overextending themselves, end up poor. They end up having their assets stripped, and it ends up, generation after generation. And this is how I think it furthers the inequality. If we just admit that the state is there, then maybe we can just say, let's just have the state just directly pay for some of this stuff, instead of having these middleman financial intermediaries making so much money off of this process.
Yeah, if I can hop in. So one thing I didn't talk about, one of the models for scoring credit lending in the paper that I'm working on uses blockchain as a technology to offer financial services intermediation rather than relying upon conventional financial intermediaries. So the argument is that blockchain brings the promise of genuine democratization of money, or this sort of, we could have had an entire MDM conference arguably with the blockchain people, because they would have said, we're bringing it, However, one of the critiques I have in my paper is I'm not fully persuaded. So the entity that I'm thoughtful about is called Bloom, Credit Bloom, BLOOM. They have a white paper that they published that describes how they intend to decentralize access to credit. And their promise is that they will offer sort of all the services of financial intermediaries without any of the costs, right? Because this is part of that blockchain revolution whereby the entities themselves can come to be sort of irrelevant, and transactions on a peer-to-peer network replace the necessity of going to the platform that is the private money, which is where all the fees are calculated and captured. The challenge, from my perspective, having read their white paper cover to cover multiple times and shared it with, in conversation, developers who are writing blockchain protocol, we can't ascertain immediately. There's an opacity issue. We can't ascertain immediately how they are transitioning or converting the decentralized data that they may have about consumers into a conclusion about your credit score. So the first problem is we assume, actually, because we can't see in its entirety the protocol, we assume that somewhere in the model they're using algorithms. They just aren't telling us that that's what they're doing, right? So they gather the data through some kind of decentralized process, but then ultimately they have to score the people. In order for credit scoring to work, people have to be assigned a number, an A+, a B+, an 800, a 740, a 500, you have to be assigned a score. And so the conclusion is, even if they reconfigure the reputational, the data points that they use to determine a score, there's still a process whereby they're using sort of a slightly conventional mechanism to score folks and to give access, if you will, to credit and capital. So there are a lot of concerns about what is actually happening there. The second piece is they are using some alternative forms of data that we have grave concerns about the likelihood that those who have been historically marginalized in these processes will be further marginalized. In fact, Credit Bloom's exact description, and this is terrifying, of what they intend to do to create a credit score is to ask you to list your friends, and based on who you're associated with, this is in the white paper, Credit Bloom, you can Google it, based on who you're affiliated with in terms of associates, and this maybe could be determined by Facebook friends, I don't know, who you tweet, I am not sure at all, but right, can you already imagine a grave number of concerns about the extent to which you're associated with non-credit worthy folks, and as a result, you are less credit worthy, right? That's the actual, they're actually arguing on behalf of this sort of reputational assignment of a credit score.
So you're going to dump me now as a friend?
No, but I imagine there are people we would all dump, unfortunately. So, like grave concerns about the genuine democratization of credit via blockchain.
Can I just pick up on Jennifer's comment? Both at the end of your talk and what you just said at the end of your answer about the government directly paying and how this is a social justice issue. Mm-hmm. Right? 'Cause the conclusion of our paper is it's not about bankruptcy. It's what history has shown is that you need the government to step in to either provide some of the services, right, or to regulate in a way so that people have enough money to pay for their basic needs. And I think the older Americans filing bankruptcy is the canary in your gold mine. And what they're saying is we need the stuff we used to have. Mm-hmm. It's not an access to credit issue, because by the time they file bankruptcy, what you see is that they had tons of access to credit. Yes, they cashed out their retirement accounts, but they put all their medical expenses on credit cards, and then on a different credit card. And then they put a loan on their home, and then they got a lien on that loan, and it just sort of spiraled out of control. And it's really about how much everything costs in relation to how much money we effectively are giving people through money as this democratic medium.
All right. So a couple points. Just, to step back and take a broader view, a lot of why I recommend a lot more public institutions directly providing credit. A lot of it goes back to, I think, Keynes's vision of socializing credit as a way to stabilize the economy, and just the socialization of credit, or the euthanasia of the rentier. And I think it's a lot. If they're public institutions, there's a lot greater role for public oversight as well. A couple other points. I think Jen's point about having some mechanism for deleveraging that doesn't destroy the bar is incredibly important. And it also ties in some ways to Pam's point about how credit policy really cannot replace incomes policy, and that goes back to the keynote we had this morning. The person talking about the pension funds in Holland, and how a lot of the financial deregulation was kind of this compromise between labor and capital. They're like, all right, we can't get extra incomes for the workers in the 70s, but let them make more returns on their stocks. In the U.S., we saw a lot of that too. It's Greta Krippner's book, Capitalizing on Crisis, talks a lot about that too, how kind of asset price inflation kind of made up for lack of income. And I think that's a huge danger, and that's probably one of the biggest fears I have actually about my proposal as well, about that really this credit can't substitute with incomes. And really, when you if that happens, you'll see what Jen's talking about, that we're going to have a huge amount of deleveraging that's going to have to occur, and we have to think about the mechanisms through which that occurs. So the way it happened in 2008, right, in the privately securitized market, which is some of my other research I'm looking at, right, there was $600 billion lost to foreclosure, right? That's how the deleveraging occurred. If we think about the voluntary loan modifications in that, and even the ones that took place under HAMP, they didn't deleverage borrowers. They resulted in a $20 billion net increase to borrower debt, right? They punished borrowers. And that's terrifying. And if we do debt forgiveness, that's kind of like a redistribution after everything bad happened, where it's much better to get rid of on the front end. One other question I would ask, though, is, you know, a lot of these algorithms and the different fragmentation of who was doing what role in the financial services market had a huge role in contributing to 07 and 08, especially with conflicts of interest, right? So perhaps if one of these fly-by-nights is doing underwriting for a credit card company and the credit card's holding the credit risk, maybe that's one thing, but what if securitization's involved? Then you have all these perverse incentives, conflicts of interest, right? I imagine the underwriting company gets a fee on the volume of underwriting, and if someone's securitizing, they get a fee for originating. So I'll be gone, you'll be gone, and let's all, right? That's how that shit works. That's how that stuff works. And so that's a serious issue that I would be.
Can I just comment? We're both going to yeah. I mean, we're probably going to have the same comment in part, at least, because you know, first when Thomas was presenting and he was sort of working through, you know, what I would describe as the micro risk management concerns that are transactional, that really feed into the systemic risk management concerns that Jennifer described, I just felt more at home than anywhere else. This is like Christmas and Thanksgiving all rolled into one for me, because my earliest scholarship was on systemic risk, and I followed Steve Schwartz like, you know, in a little mini apostle, right? Because I thought he really has touched upon something that as a policy matter will continue to be a challenge for us if we can't get our arms around it. It's what are the triggers, right? So Steve says, you know, we're looking for something that really triggers a contagion, that triggers a domino effect of losses across the market. And notwithstanding the conversation prior to 2010, around this question of systemic risk, which is why it shows up so frequently in the Dodd-Frank Act, there was no political will to actually attempt to define and address it. There was so much political will to address, as you described also in your talk, the problems of the last crisis. So we have say on pay in the Dodd-Frank Act, which I'm sure resolved all of nothing that related to everything Thomas just mentioned and he described in his paper. So if we walk through the interest rate risk, if we walk through the solvency risk, the liquidity risk, if we walk through credit or counterparty risk, we're talking about at the transactional level or even just the fragmentation across the market, and the idea that we had Alan Greenspan sit before multiple panels of Congress and in other instances and essentially say credit derivatives are wonderful products because they make for a more healthy economy by allowing us to deal with risk in a whole new way, rather than a single entity having to sort of house that risk on their own balance sheet. They can share the risk with others, right? Like, you know, another kind of Christmas, not really. And so at the end of the day, I think these two issues are really critical. And I actually would say I was very conservative in my expressions of what I think about what's happening in the context of the development of algorithms, the reliance of this sort of segmentation within the market and the fragmentation of the market. I think there's something tremendously terrifying there. And I present this paper, and I often describe it as I bring the apocalyptic, you know, predictions, which I don't think are positive. And Jennifer like sort of drove it home, I thought. So
so I have a stepping back comment to make, just to be clear, which it ties into something Chris Dassan said this morning. So first, here when I'm talking about firms, I'm talking about financial firms. I want to really distinguish between private operating firms that make things, and for a moment. So hold that thought. This morning, Chris was talking about, during the Civil War, the use of greenbacks to get volunteers, in quotes, instead of coercive conscription, right? Mm-hmm. And that just made me think quite a bit about money as a way to force people, get people to do stuff, get out of bed, right? We know this idea, creates, this is why private firms like to have it, because you get people to do what you want them to do, right? So I understand that, and I really do believe in money as an incentive, I'm not trying to make a, well, how do I say this? That's a description, not a normative claim. Money does work as it has an incentive power in that way. So I want to take it a step further, which is, if we're organizing a society and we look around and we say, and you hear these complaints all the time, people are not getting the education and training they need. Folks aren't getting we have a shortage supply of doctor, all these different things that we say. And so I think, if the state's willing to pay volunteers to go to war, and we do it now, we pay people to fight, we pay to be ready to, why don't we pay people to go to college? I mean, I want to take it a step further. Instead of free higher education, why don't we pay people to do that? And I know that's not meant to be a radical comment, but let's really think about how is the government using the money that it creates.
Yeah.
And if we thought about this very differently, why aren't we paying people to have good health by providing their health? What does it mean to have a functioning society? If money is an incentive, why is the government taking away all its power to incentivize people to behave in the way it wants them to behave by letting the private sector have? Why are we only using the stick? You screwed up, you go to jail. You screwed up, you go to jail, we don't have rehab for you. Why don't we pay instead of punish? I mean, it just seems so, and I must not be the first person saying this. Anyway, go, Jami, tell me.
No. I was actually thinking, I started out with Martha's comment about democratization, and then I went Thomas, and then Jennifer, you said something came together.
Could you speak up a little bit more?
I'll repeat his question.
Look, okay, so public banking. Yeah, I thought that public banking is something like a public works program, in the sense that how a public works program, the jobs program, how it does it, it increases the bargaining power of labor, right? So this, I think, comes to I think, Jennifer, your point that okay, so we have capitalist job markets, but then either you don't have a jobs program, which means that workers are completely, the bargaining power is completely in favor of employers, or you have that and that increases the bargaining power, right? And so a public banking system, I think, would be one way of democratizing credit. In other words, it would put pressure on private bankers to not engage in certain things that they do now, because there is a much more efficient and just, consumer anyway, public banking system, or they just like a public works program. So I think that comes to your point. Why does this happen? And I think it doesn't happen because of massive corporate power, right? Which is beating back against the state, against the public sphere. I mean, we did have higher education, which was free and all this, right? So I think that thinking back about redoing democracy is also about really seriously confronting corporate power and its massive influence in sort of shifting the seesaw in favor of the wealthy and corporations as opposed to the larger society. And that's, I think, I had one question for you, Jennifer, and actually a suggestion. In terms of your canary, have you looked at any of Wynne Godley's work? Okay, so.
Can you say the name again, Jami?
Okay, so W-Y-N-N-E, Godley, G-O-D-L-E-Y. There is so he did that in the late Wynne Godley. He passed away a few years ago, but he done a lot of work on household debt to income ratios, and he was already talking about in the 1990s that this was reaching unsustainable levels. So in terms of your early warning indicators, there are two comments I have. One is that particular chart that you put up that sometimes is used, household debt to GDP.
Yeah.
I don't think it's a particularly good, right? Because you're talking about apples and oranges over here. It should be household debt to household income.
Exactly.
Oh, okay.
So that brings me to my third point. I'm sorry if I don't want to go on with it. But there is a well-known relationship in macroeconomics that if you're a household and you're running a deficit, so you're spending more than you're earning, if the interest rate of your debt is greater than the growth of your income, your debt to income is going to shoot up. Unless, of course, the economists will talk about it, unless the debt content is, that's your story, right?
Indexed, yeah.
But that's an indicator that's often used.
Thank you.
It's a good indicator.
Thank you.
Can I respond to that?
And I actually.
Okay.
All right.
Derek, can we just?
Oh,
get Derek
okay,
in
yeah,
there?
sure.
Okay, I guess I have some comments and then a question also. You know, Jennifer, I might use a different frame rather than incentivize behavior with money, but I'd frame it in a Maurer sense, human capabilities. How do we facilitate people with money,
Thank you.
not presuming that they're doing things behaviorally problematic to begin with. And then the case for public banking, I think it's really made in Fishing for Fools by Apple
absolutely.
and Scheller, where they talk about the profit motive inherently leads the finance sector in particular to want to extract, to want to deceive,
Right.
want to,
Yeah.
that is their motivation.
valuable.
to take
Absolutely.
people.
Valuable.
He probably stopped short from advocating public banks because his wife was the Federal Reserve chief. People probably would have advocated it. And then with regard to credit scores, they should be federalized.
Oh,
Some-
interesting.
so- and I guess y'all agree, but it should have the transparency of government
Yeah.
as well as the accountability of government, and data sovereignty issues are clearly relevant when it comes to who gets the profit from the information that I offer as
That's
it relates to
right.
me. With Raha Benjamin at Princeton University, she's done a lot of work about algorithmic, people are arguing.
Yeah,
that
I've seen the
algorithmic-
pieces.
so you've seen it, but I
Yeah.
can tell the rest of you
No, yes, please.
that robots are aracial. The robots aren't racist. So using robots as a learning mechanism to come up with ways to rate people is a way to mitigate some of our racism. However, the robots replicate our behavior. They learn from a platform that we've established, so the robots, there's evidence that the robots themselves are behaving racist also.
That's right.
And then, you know, another point is, rather than the framing around access to capital as opposed to access to credit.
Well, that's great.
Maybe that changes the narrative. And then here's my little pushback a little bit with regards to why the elderly. Of classes we can protect, and I get the graphs about their fastest growth rate, but part of it is they started at the lowest position relatively compared to some other groups. So if we look at absolute numbers, we should protect everybody. I guess the question is why focus on the elderly? In an absolute sense, they might not have the largest increase, and they might be at the lower end. And they're one group that at least has, although inadequate, Social Security.
Can we respond really
Yeah.
quickly now? I just wanted to say one tiny thing, and Johnny left, that was related to the public bank suggestion. It also goes to Derek's comment as well. Thank you so much for the several of them, all really helpful. And it's simply this goes to the rent seeking on the part of financial institutions. They will never go away. So when you talked about the public banking option, as a former Goldman Sachs employee, as a former vice president and associate general counsel at JP Morgan, I have to admit and acknowledge they will not be disappearing. I don't really see that happening. And even to the blockchain revolutionist, Don Tapscott in his book, Blockchain Revolution, describes this democratization of access to capital that blockchain will bring. And then almost as an aside and quickly at the very end of a chapter, he notes, and by the way, the largest financial institutions have already gotten together and they're working on organizing a privatization of blockchain. So what was meant to be by definition a permissionless ledger, that was the idea of blockchain, a digital ledger technology that everyone could participate in, anyone who could log on to a computer or connect could access to blockchain, could freely access the data, no limitations, no fees. Permissionless ledger is part of the description of what blockchain was meant to be. The banks are now creating permissioned versions of the ledgers. In other words, they're hijacking the technology. And before we will ever perfect it as a society, they will have perfected it because there are rents to be collected, and they will not leave that money on the table.
Can I respond to
Oh, yeah,
the
go for
older
it.
American things? So, I mean, in terms of, maybe I misheard you, but shouldn't older Americans have the most? Like, the people who file bankruptcy, older Americans need to have a cushion to live on in their retirement, and so they should have built their wealth into their retirement. And the older Americans who don't file bankruptcy seem to have enough to survive if they were living like 10 years ago. And now they don't. And we're focusing on them because they show up in bankruptcy in such dire straits, and that the percentage of them filing increased within the bankruptcy population, and in relation to their growth within the American population so quickly. And older Americans, as a percentage of the general American population, are going to continue to increase as a percentage. And so in coming years, what we see happening now is only going to increase in magnitude overall. And then we as a society either are going to decide to help them and do something about it, or just sort of like leave them on the street to die. And that's sort of why we picked on that data point now.
Yeah. Let's get to some more questions here. Yeah, in the middle.
Yeah, I want to hear more about former post office banks. Two things specifically, what kind of services it did offer, and was it chartered as a bank by the federal government to act like a bank, like the Bank of the State of North Dakota is? Because you know there's a whole movement now for public banks at the state and municipal level, but you're talking about a people's bank. So what did it do? What did it do when it was there?
All right. Should I just answer that now, or?
Yeah.
Okay, so the U.S. Postal Savings System was, if I remember right, it was roughly 1917 or 14-ish up till it finally withered away in the, I want to say the mid-60s, but by then it had been defunct for a while. And there was, it was interesting. It arose in some ways as a discussion about an alternative to deposit insurance. But after deposit insurance happened, people used the commercial banking system. But really, I think the real issue, so one, it wasn't like the State Bank of North Dakota. It only targeted households. But it had competitive restrictions on it that basically rendered it obsolete. And this kind of gets into my issue with some of the new postal banking proposals. They specifically want to provide banking services to the unbanked, they don't want it to compete with commercial banks, only serve those who are excluded. But I think that public-private competition is, one, an incredible regulatory lever, and two, it was the competitive restrictions on the USPSS that caused it to be obsolete, right? You had limits on how much savings you could hold there, and they would pay you less of an interest rate than you could get at a commercial bank. Indeed, they even held their savings at the commercial bank. And so because of those competitive restrictions, and then after deposit insurance, it just kind of withered away, and it wasn't a big factor in, after the New Deal, essentially. But that's very different. So the State Bank of like North Dakota, right? That would be the government putting its tax receipts in its own bank so it could generate credit, rather than say, like in LA, I'm from LA right now, and they're talking about, hey, why don't we have all our tax receipts held in our own bank rather than Wells Fargo? And for reasons, that makes sense. A couple other points I want to circle back to really quick. I was trying to wait for Jame to get back in the room, but this connects a lot of things, so I might as well say it. So one of them, why not wither social democracy, right? What happened to our, there we go. So great, I was just going to circle back to some of your points. So the question, wither social democracy, what happened to even the bare minimum social safety nets that we've had that kind of leveled the bargaining power between labor and capital? And really, in my view, it's the Kolesky problem, right? Like, technically, it's not a bridge too far to set up these public institutions, but it's something Kolesky talked about in Minsky as well. What happens to the relative bargaining power between labor and capital when you maintain a full employment program, right? It becomes much more even, and then you lose discipline on the shop floor, and that's why businesses have opposed consistently full employment programs. That's Kolesky's famous article, Political Aspects of Full Employment, 1943.
Exactly this point, by the way.
Yeah, it's true, and it's the thing that is always in the back of my head. Like, this is a beautiful idea, but yes, it's going to take a change in the balance of power. Another thing about household debt. So one, I think it's something I should have said earlier too, but it is an incredible canary in the coal mine because busts that follow large run-ups in household debt are always the worst, right? Mo Skularick has a great paper on that as well. The IMF shows this and shows why debt forgiveness is actually really good from a macroeconomic perspective. Also about the household debt to income ratio. This is very important. It's the Fisher effects, right? That your debt to income ratio depends not only on how much you borrow in a given year, but inflation, the interest rate, and the rate of growth of your income. So if we look at U.S. history, there's a marked change in the Fisher effects facing households from roughly 1950 up to 1980 and 1980 up to 2002. A Mason and Jayadev paper, AJ Macro, I want to say 2016, I could be wrong in the date. But what they showed is, interestingly enough, in the post-war period, right, 1950 and 1980, essentially households were able to run deficits but still have their debt-to-income ratios fall through time due to essentially negative real interest rates. It was also how the U.S. paid for the war. We ran deficits, right, in the 60s and 50s, but debt to GDP fell. And that's the Hall and Sargent paper shows that, even a Reinhardt paper shows that as well. But 1980 to 2000, around 2000, households actually often ran surpluses, but their debt to income ratios increased through time because of the great moderation, right? High interest rates, low inflation, low income growth. That killed households' debt to GDP ratio. Now, 2002 to 2007, that was different. They did borrow quite a bit. That's the housing boom. So that's an incredible, and that gets into the point of that the capitalizing on crisis point, right? Greta Krippner about credit cannot replace income policy. It just can't. Finally, fishing for fools, right? That's incredibly important. So a lot of my research is estimating the effects of mortgage fraud on foreclosure. Mortgage fraud is caused by the big financial institutions, some you worked with. They're in my data set. I have 40% of the privately securitized loan market. And yes, if consumer financial protection abuses are profitable, people are going to do it really big. Right. And it doesn't take a long time, right? 02 to 07 was the housing bubble. That's 5 years. And that destroyed a generation of wealth and just crushed the economy for more than a decade. Well, a decade now. I'm not. That's a different question. Then the question of, does Goldman always win? On some sense, yes, Goldman always wins, and they're not going to go away. However, public-private competition from below makes that a lot harder. I don't think we're going to compete them out of, and even these would serve different markets. Like Goldman's serving corporations to the extent that Goldman robs AT&T. I'm like, yeah, but if they rob the whole working class, that's a little bit more, right? And this makes it a lot harder. This makes it quite a bit harder. For entities like Goldman, I would just say, like, I think we should put more of their executives in jail. That's a criminal justice issue. Kick doors on the
Jennifer can go back and forth on that.
Kick door on the boardroom. Like, treat the executives like low-level drug offenders, and this would all be over, right? Throw them in jail for 20 years.
I didn't say this panel was going to be about that.
Yeah, sorry. And maybe I shouldn't have said that, but no, that's kind of been. It would make a great Hollywood movie. Can you imagine a SWAT team jumping off the roof, like fast roping down to the boardroom? I mean, it's.
If you got public banks, you can let the market decide.
Yeah, exactly. They go out. Exactly, absolutely. And really, that was actually some of the big arguments for a public banking system before deposit insurance. Get rid of the moral hazard.
Yeah. We're almost out of time. Maybe we could
Just take the question.
I guess one more question, or maybe two questions, and then we can just
We'll
a couple questions
please.
get at once, and then we'll have final comments.
So I was just going to ask about, Thomas was talking about public banking as a sort of as a consumer protection, or a postal bank as a consumer protection measure, and I was thinking specifically about data collection and whether having like relatively simple standardized products that are relatively easy to pay off to people from a variety of incomes and balance sheet positions reduces the need for the sort of that Kristen was talking about, is more and more scoring methods and ways to bank the unbanked and go after people rather than just sort of subsidizing credit and providing easy products that you don't actually you don't have this surveillance mechanism that's as necessary. You can have relatively basic information about people and help design the product for them. That might be another advantage of having a postal banking system.
Yeah, I think information discovery is an incredible thing. Also, discovering the true cost of what small dollar unsecured lending would be. Moreover, from an infrastructure perspective, it would. Maybe we can't replace. It's not. You can't replace incomes policy with credit policies, but you could do cross subsidization like they do in every other infrastructure thing, right? Like the post office. There are just some routes delivering mail to that it will never be profitable to send a letter out to Nome, Alaska. It just doesn't. Or somewhere out in the middle of Wyoming. They knew that since the very beginning, but they knew there'd be profitable routes, and that could subsidize the unprofitable routes. Same thing with buses and any of the universal service requirements on any of our infrastructure. So we could do that with a public bank, right? We could find out the true cost, right? Like payday lending doesn't cost 400% interest rates. That's stupid. And it could be quite a bit less. And if it still wasn't decent enough, well, you know, on financial services to the middle class or the, you know, whoever else, you could charge a little slightly higher interest rates and have cross subsidies. And that'd be, from an infrastructure perspective, that'd be really useful.
Okay, let's go to one more, the last question, and then we can have final comments.
With respect to Pamela, with respect to foreclosures and bankruptcy, of course, the people have to go and know that they have the option of foreclosure, of bankruptcy and the foreclosure. Well, a lot of people don't. I advise some people, and a couple of people I've advised didn't know that there was a bankruptcy option, and the court doesn't necessarily go and let them know either, and they have to declare it. So I would love to know on their last three categories of your ages, such as the, I forget what the, after over 65 or whatever it is, or, and 50 to 55, whatever the last two categories of age, how many of those people drop off the curve that didn't file for bankruptcy that could have filed, and perhaps even are in the box cities and tent cities in the Chicago or in San Francisco, thousands and thousands of people that have just dropped off the face of the earth because they weren't aware of that. I'd love to know that. I don't know how you'd have to figure out how to go and include that type of data in your survey.
Yeah, so if we're going to do final comments, maybe my final
Yeah.
comment can be in response to that. So in terms of age brackets, I can't give you an estimate because I don't know of anything broken down. But there have been papers from economists that show 15% of Americans generally could economically benefit from filing bankruptcy. And I bet it's about 15%, right, of older Americans that are in the same sort of financial problems, not necessarily mortgages specifically, but it's all tied together. So the answer is a whole lot of people don't file for bankruptcy, potentially because they don't know about it, or they're too stigmatized. Or they give up. And who knows what happens when they give up. But this question is actually the other paper I mentioned called Life in the Sweatbox, about how we think people figure out that bankruptcy is an option. And it's actually the foreclosure proceeding that we think triggers a financial problem, is a legal problem, and then they start thinking, oh, law, there's that word bankruptcy, maybe I should look into it. And debt collection and debt buying and then rebuying and then having different debt collectors contact people, we think has pushed different subsets of people to file bankruptcy over the last 10 years. So I'll end there.
Okay, any other comments to wrap up? We've said a lot. Thank you all.